Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A tech bloodbath rocks Wall Street as the Nasdaq plunges 1.9%, triggering a massive capital flight. Is this the end of the tech rally or a make or break moment for smart money? Second, alert. Job cuts hit a 22-year high, soaring 183% as the AI arms race triggers a layoff tsunami. With official data dark, is the Fed flying blind into a recession? And what does this hidden truth mean for your portfolio? Finally, Meta's revenue empire masks a dark secret, a staggering $16 billion from scam ads revealed, shaking the foundations of the entire tech industry. This isn't just about Meta, it's a critical threat to the AI arms race. How could this single revelation trigger a valuation crisis for all of big tech? Markets are in turmoil, folks. The Nasdaq just nosedived 2.8% this week. This is a wake-up call. I'm telling you, today's market action is a stark reminder that the high-flying tech sector is losing its sheen, and you'd better listen up if you want to protect your portfolio. The S&P 500 slid 1.1% today, closing at 6,720.32, while the Dow managed a smaller 0.8% drop to 46,912.30. But the real story is the Nasdaq's brutal 1.9% decline, hammering home the message that tech stocks, once the darlings of 2025, are now under siege. This isn't just a bad day, it's a clear signal that investors are spooked by persistent inflation and the labour market's shaky footing. With earnings disappointments from DoorDash and CarMax dragging the indices down, it's time to reconsider your tech-heavy positions. Let's break it down. Today's market woes are rooted in several critical issues. First, the economic signals are mixed at best. While the ISM Services PMI rose to 52.4% in October, indicating some expansion, the ADP report showing a meager 42,000 job additions tells a different story. The labour market is faltering, particularly among small and medium-sized businesses, which are shedding jobs, signalling broader economic stress. This divergence is compounded by a surge in layoffs, with October seeing 153,000 announced cuts, highest in 2 decades, driven by cost-cutting and AI automation. On the policy front, the Fed is in a bind. Despite a 67.5% probability of a December rate cut, uncertainty looms large. Chicago Fed President Austin Goolsby's recent comments cast doubt on future cuts, despite labour market weakness. Meanwhile, Treasury yields are reflecting this uncertainty, with the 10-year yield dipping to 4.09%, a classic risk-off move as investors flee equities for bonds. The money flow picture is equally telling. Capital is rotating away from growth-heavy tech stocks into more value-oriented and defensive plays. This is a classic flight to safety, with the VIX inching up as investor appetite for risk wanes. We're witnessing a valuation correction in tech, with P divided by E ratios under pressure as the market recalibrates expectations. Listen to me, here's what you need to do. Cut your tech exposure now, rotate into financials and energy sectors that stand to benefit from higher interest rates and geopolitical tensions. With financials like XLF and Energy XLE poised for gains, there's no time to waste. This isn't just a tactical pullback, it's a strategic shift. Act now to protect your portfolio's upside potential. Sector-wise, today's winners are those with concrete earnings and strategic moves. Snap surged 18 to 25% on a promising $400 million AI partnership, while Datadog climbed 23.1% on strong quarterly results. These are the companies executing with precision, combining growth with profitability, a stark contrast to DoorDash, which plummeted 17.5% on warning of future spending, and CarMax's 24.3% dive on weak guidance and CEO exit. Now, for actionable recommendations, good advice makes you rich, bad advice costs you a fortune. Listen to me short term. Reduce tech exposure by 15 to 25% immediately, focusing on trimming holdings like Meta and Microsoft. Medium term, add 3 to 5% to financials, XLF, and 2 to 3% to energy, XLE. These positions will benefit from a high interest rate environment. For defensive positioning, allocate 2 to 3% to consumer staples, XLP, and 1 to 2% to utilities, XLU, to hedge against further economic downturns. For risk control, set a stop loss for the Nasdaq at 420, and for bonds, exit if the 10-year yield exceeds 4.5%. Hedge with QQQ puts for tech and SPY puts for broader market protection. Advanced investors should consider interest rate swaps to capitalize on potential Fed cuts. The clock's ticking, folks. With key earnings on the horizon and a government shutdown looming, the smart money's already repositioning. Don't wait for the market to force your hand, act decisively. Now, let's take a closer look at the specific stories driving today's action. Job cuts just hit a 22-year high for October, soaring a staggering 183% in just 1 month. That's over 153,000 announced layoffs, according to a new report from Challenger, Gray, and Christmas. The surge is so severe, it makes this the worst year for announced layoffs since 2009. Now, get this. The Challenger report is what economists call a leading indicator. It doesn't track people who've already lost their jobs. It tracks announcements of future job cuts. This means it reflects what companies are planning to do, giving us a glimpse into their future expectations and strategies. That's why Wall Street pays such close attention to it. A while back, we said that with parts of the official data flow going dark, forward-looking series like this would carry outsized weight. Today's print is exactly that. So what's driving the sudden spike? The report points directly to the artificial intelligence boom, calling it a disruptive technology changing the landscape. This is where the situation takes a more complex turn. What we're seeing isn't just a typical cyclical downturn where companies cut costs during a recession. The key here is that this is a structural shift. Many experts believe this is a one-time, massive reallocation of capital and labor towards AI. Companies are aggressively freeing up cash, not just to survive, but to invest heavily in the AI arms race. For instance, we're seeing giants like Microsoft planning to spend around $80 billion and Alphabet around $75 billion on AI infrastructure alone. For a Chinese-speaking audience, it's important to understand this isn't just about corporate efficiency. It's a strategic repositioning by the US private sector to accelerate its lead in generative AI with global competition in mind. This creates what's called a skills mismatch. The jobs being eliminated are not the same as the new jobs being created, which can cause a temporary but sharp spike in unemployment. The tech sector is ground zero, with companies there announcing nearly 6 times more cuts in October than in September alone. Consumer products and non-profits are also seeing sharp increases in layoffs, with non-profit cuts up a shocking 419% so far this year compared to last. But the rabbit hole goes deeper. This grim data directly clashes with other reports showing modest job growth, creating a deep sense of uncertainty on Wall Street. So the thing is, this clash of data is creating a puzzle. The Challenger report tracks times announced times layoffs, while other data like weekly jobless claims track times, actual times, people filing for unemployment. The gap between these two indicators suggests that companies are signaling their intent to cut jobs, but they haven't fully executed those plans yet, perhaps due to severance packages or phased layoffs. The critical question everyone is watching is whether these announced cuts will soon turn into a wave of actual unemployment claims. Even the Federal Reserve, which has been cutting interest rates to get ahead of a slowdown, is now facing a labour market that may be unravelling faster than anyone anticipated. We previously analysed how the Fed could be pushed into a real-time reactive mode when the usual guideposts go missing. This report adds pressure right where it hurts most. The labour mandate, and here's where it gets interesting. The Fed is in a particularly tough spot right now. Due to a government shutdown, the release of official economic data from agencies like the Bureau of Labour Statistics has been suspended. This forces the Fed to rely more heavily on private and sometimes more volatile data like this Challenger report. As we discussed a while back, when the gold standard non-farm payrolls report goes missing, the committee leans on noisier proxies like weekly jobless claims, and the risk of a policy error rises. If they overreact to this single report and cut rates too aggressively, they could reignite inflation. But if they don't act fast enough, they might fail to prevent a sharp recession. Remember, markets were already pricing a near certain cut. Today's layoff surge gives the doves more ammunition, and any dovish dissent at the FOMC would signal that internal pressure to move faster is building. For our Chinese-speaking listeners, recall our earlier note, an aggressive easing cycle tends to weaken the dollar and gives the People's Bank of China more room to maneuver. And one more angle, we flagged an early end to quantitative tightening would be a form of stealth easing that boosts liquidity even before additional rate cuts. But that's not the whole picture. The report also issues a stark warning. Those laid off now are finding it harder to quickly secure new roles. This signals that the post-pandemic hiring boom may be officially over, as rising costs and softening consumer spending force companies into a wave of belt tightening and hiring freezes. So, looking ahead, what should we be watching for? The key is to see if this weakness, which is currently concentrated in specific sectors like tech and nonprofits, starts to spill over. The real recession signal will be if we start seeing similar layoff announcements in core cyclical sectors, think manufacturing, logistics, and broad business services. If the weakness stays contained, the broader economy might be able to withstand it. But if it spreads, that's a much more serious sign. This all leads to one jaw-dropping figure. So far this year, companies have announced 1.1 million cuts, a 65% increase from a year ago, and the highest level seen since the 2020 pandemic. Speaking of the immense pressure on the tech sector, a different kind of risk is now emerging from within one of its biggest players. Internal documents at Meta just revealed a number that's shaking the ad world. The company projected that a staggering $16 billion of its revenue last year came directly from scam ads. That's 10% of Meta's total $164.5 billion in sales, allegedly flowing from promotions for fraudulent e-commerce, illegal online casinos, and banned medical products on platforms like Facebook and Instagram. This situation presents a fascinating duality. On one side, you have this massive revenue stream, while on the other, it exposes what investment circles call junk revenue, a hidden risk to a company's earnings quality. A while back, we laid out how digital ad revenue has become a leading indicator for the AI capital expenditure boom powering the current tech cycle. If a meaningful slice of that ad spend is junk revenue, the risk isn't just to Meta's earnings quality. It cascades into the funding of the broader AI build-out. If regulators decide to crack down, it could trigger a sudden repricing of tech growth stocks as this revenue stream evaporates, and the human cost is real. According to the US Federal Trade Commission, consumers reported losing over $1.2 billion to fraud that started on social media in a single year, more than any other method. What really brought this to a head was the next development. While Meta publicly states it aggressively combats fraud, other internal documents reportedly show a major concern within the company that abruptly removing these fraudulent ads could significantly impact its own business projections. Continuing our last discussion about the advertising empires bankrolling the AI arms race, that internal worry isn't just about next quarter's targets. Those ad cash flows are the fuel for AI investment. Less fuel, slower engines. This reveals a core conflict between platform safety and revenue. Believe it or not, this reveals a deeper, more technical challenge. Meta is pouring tens of billions of dollars into AI, partly to solve this very problem, but we're actually seeing an arms race between AI-powered fraud and AI-powered detection. While AI helps platforms scan billions of ads, fraudsters are also using AI to create more sophisticated and deceptive content that can bypass these systems. Remember, we also talked about the paradox. The very AI these firms are racing to build could disrupt the ad models that fund it. Think AI-driven search and shopping, siphoning attention from traditional feeds. Layer today's moderation gap on top of that, and the ROI on those massive AI investments gets even murkier. The effectiveness of a platform's AI in content moderation is becoming a key differentiator, and failures like this raise questions about the true return on these massive AI investments. The scale is hard to comprehend. One document cited in the report estimates that Meta shows users 15 billion of what it internally calls higher risk scam ads every single day. Another document estimated that these clearly deceptive ads alone generate roughly $7 billion in annualized sales. So, a natural question is, where are all these ads coming from? Interestingly enough, a significant portion is linked to a major trend in global e-commerce. US Customs has a rule called de minimis, which allows packages valued under $800 to enter the country duty-free. This has been a huge boon for cross-border e-commerce sellers, particularly from China. However, US government reports have raised concerns that some sellers may be using this loophole to ship goods that bypass regulatory scrutiny. This creates a complex situation where US platforms like Meta become a key advertising channel for these sellers, potentially putting the platforms in the middle of a growing issue around trade policy and consumer protection. Now, Meta is pushing back. A spokesperson called the $16 billion figure a rough and overly inclusive estimate, adding that the leaked documents present a selective view that distorts the company's full efforts to fight fraud. But, regardless of the exact number, the trend and its potential consequences are what's critical here. This persistent gap between a platform's stated safety policies and its actual revenue from violating content is accelerating a major shift. The era of tech self-regulation may be coming to an end. We previously noted the EU's DSA as a template. If US policymakers follow suit, it won't just hit near-term revenue. It could also compress the capital flowing into AI infrastructure that these ad empires bankroll. Such rules could fundamentally alter the business model of social media by making platforms more legally responsible for the content they amplify. But the documents lay bare a fundamental challenge for the social media giant. They paint a picture of a company grappling with a multi-billion-dollar revenue stream allegedly tied to fraudulent content and the difficult choice between protecting its users and protecting its own bottom line. And as we've seen a while back, markets are extremely sensitive to signs that ad-funded growth is less durable than it looked one high profile. AI product launch was enough to trigger a sharp one-day sell-off in a mega cap, underscoring how quickly sentiment can swing. So, what should we be watching for going forward? The first and most important focal point is regulatory action. Watch for announcements from agencies like the FTC or for new legislative proposals targeting platform liability. This is the primary catalyst that could force change. Secondly, this widespread fraud acts as a hidden tax on household finances, eroding real disposable income and, just as importantly, trust in the digital economy. Given the tight link we discussed between ad revenue and AI investment, also keep an eye on AI capital expenditure guidance from Meta and Alphabet if enforcement ramps up. That linkage is where you'll see the next order effects. This could eventually become a measurable drag on consumer confidence.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.